In what could have been a transformative move for South Africa's struggling industrial sector, President Cyril Ramaphosa recently unveiled a plan to offer cheap electricity to the country's steel industry. But critics are already questioning whether the timing of this initiative is too late to reverse the damage wrought by years of energy uncertainty and a crippling economic slowdown. For decades, South Africa's steel producers have grappled with soaring energy costs, rolling blackouts, and aging infrastructure. These challenges have not only driven up production costs but have also hampered the global competitiveness of local steel, forcing manufacturers to scale back operations or, in some cases, shut down entirely. Analysts say that the industry has been teetering on the edge for years, waiting for decisive intervention that could stabilize operations and provide a clear path toward growth. Ramaphosa's announcement, which came during a high-profile address at the Department of Trade, Industry and Competition, promised targeted reductions in electricity tariffs for major steel producers. According to government sources, the plan would allow companies to purchase power at a fraction of the current cost, providing immediate relief and, theoretically, boosting production output. The president framed the initiative as part of a broader strategy to revive South Africa's industrial base, create jobs, and attract foreign investment. Yet the proposal has sparked debate among economists, industry insiders, and opposition parties alike. Critics argue that while the measure may provide short-term relief, it fails to address the structural issues that have long plagued both the steel sector and South Africa's energy grid. Load shedding remains a daily reality, with Eskom struggling to meet demand, and power outages continue to disrupt production schedules across industries. Cheap electricity alone will not solve decades of neglect, says Dr. Lerato Kumalo, an industrial economist at the University of Johannesburg. The industry needs certainty, long-term investment, and a sustainable energy plan, not a stopgap that may arrive after the worst damage has already been done. Timing is another sticking point. Many steel companies have already faced crippling losses, and some have begun relocating operations to neighboring countries where energy supply is more reliable and costs are predictable. Analysts warn that even with lower electricity prices, South African steel producers may struggle to reclaim market share they have lost to international competitors. The damage to investor confidence is real, explains Thabo Masiko, CEO of a mid-sized steel manufacturer in Gauteng. A late intervention might help some firms survive, but it cannot undo the years of lost opportunity, production delays, and reputational damage. The political implications of Ramaphosa's plan are equally significant. The government has long positioned itself as a champion of industrial renewal, but repeated delays in energy reform have drawn sharp criticism from both business leaders and labor unions. Unions have welcomed any relief for the steel sector, but they remain skeptical about whether the plan will deliver tangible benefits for workers, many of whom have faced wage stagnation or job insecurity due to erratic production schedules. Meanwhile, opposition parties have seized on the announcement as evidence that the government is reactive rather than proactive, highlighting a pattern of delayed interventions across key sectors. Despite these concerns, there is cautious optimism among some industry observers. If implemented effectively and paired with broader reforms to improve energy reliability, the reduced electricity rates could provide the steel industry with a lifeline, helping firms stabilize operations, protect jobs, and even expand output. However, experts agree that without addressing systemic challenges, aging infrastructure, governance issues at Eskom, and the broader need for industrial strategy, the plan risks being seen as a well-intentioned but belated gesture. In the final analysis, Ramaphosa's initiative underscores a recurring tension in South African policymaking, the need to balance immediate relief with long-term sustainability. The steel industry may gain temporary breathing space, but the broader lesson is clear: delayed action in critical sectors comes at a cost, and even the most generous subsidies cannot fully compensate for years of inaction. For the steel industry, the clock is ticking, and the question remains whether cheap electricity, finally on the table, will be enough to secure its future or merely a last-minute attempt to salvage a sector that has already been battered by neglect and uncertainty.